Hi traders, do you want to stay ahead of the market and make better trading decisions? Then you need to know about leading indicators. Unlike lagging indicators that confirm trends too late, leading indicators help predict price movements before they happen. So in this video, we'll break down the best leading indicators for day trading, how they work, and how to use them effectively. Stay tuned because this could be the game changer your strategy needs. Make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss out on trading strategies that can improve your game. So what exactly are leading indicators? Now, these are technical tools that help traders forecast potential price movements before they occur. They work by analyzing market momentum, volatility, and price action to provide early signals for potential trend reversals or breakouts. So this is why they are essential for day traders who need to react quickly to short-term market changes. Okay, now let us break down some of the best leading indicators that can help improve your day trading strategy. The first indicator we are going to be looking at is the relative strength index. Okay, this is also called the RSI, okay, for short. Okay, now this indicator measures the speed and change of price movements to identify overbought and oversold conditions. When the RSI is above 70, it suggests that an asset may be overbought and due for a reversal, right? You can see this as an example. When the RSI got towards the 70 level, you can see that shortly afterwards, as the RSI started coming back down, we had a reversal, right? This was initially a bullish move. As you can see, we had a bullish trend just before this overbought condition, or let's say near overbought condition, happened, and just shortly afterwards we had a bearish reversal. Okay, on the other hand, when the RSI is below the 30 level, it indicates that the assets may be oversold and it could bounce back up. So there is a possibility of us seeing a bullish reversal soon. All right. Okay. For day traders, using RSI on shorter time frames like the 5-minute or 15-minute chart can help pinpoint potential reversal points and entry opportunities. But remember, RSI works best when combined with other indicators to confirm signals. Okay, the second indicator we're going to be looking at is the stochastic oscillator. All right, the stochastic oscillator is another momentum indicator that helps traders spot trend reversals. It compares the closing price of an asset to its price range over a set period and moves between 0 and 100. Now, a reading above 80 suggests overbought conditions, while a reading below 20 signals oversold conditions. Okay, when the percentage K line and the percentage D line crosses in overbought or oversold zones, it can indicate a potential market reversal. Now, one effective way to use the stochastic oscillator is to combine it with RSI for stronger confirmation. If both indicators show overbought or oversold signals at the same time, for example, let's use a very good example. Okay, let's look for one. For example, here we can see what happened here, right? The RSI showed overbought condition here. The stochastic oscillator also showed overbought condition, and you can see that shortly afterwards we had a significant reversal. Can you see? all the way down, all the way down, all the way down to this point. So you can see that this was a massive sell move. It was a significant sell move right after this confluence. Can you see? So if you had taken this move, perhaps you would have caught somewhere around 580 pips. That's a big one. So basically, it's not like, you know, there is a guarantee of making fat pips after you get a confluence, but this is just an example, right? So whenever you have a confluence between both indicators, there is a chance that you're going to have a significant move, or at least you're going to have a valid move, all right, in the direction of the signal. Okay, now the next indicator we're going to be looking at is the Bollinger Bands. All right, the Bollinger Bands are a great tool for tracking market volatility. They consist of 3 lines. The middle line is a simple moving average, while the upper and lower bands are standard deviations away from it. So when the price moves closer to the upper band, it suggests that the market might be overbought. When price moves near the lower band, it signals possible oversold conditions. A breakout beyond the bands can indicate increased volatility and a potential trading opportunity. One key strategy is to look for squeezes. All right. When the bands tighten, it suggests low volatility, and when they expand, it often signals a breakout is coming. So this is extremely useful for day traders looking for explosive price movements. Next up, we have the Fibonacci retracement. Okay, Fibonacci retracements are used to identify potential support and resistance levels. They are drawn from a significant high to a low point, and with the key levels are 38.2%, 50%, and 61.8%. Okay, they often act as strong reversal zones. Okay, day traders use Fibonacci retracements to find high probability entry points. When price retraces to a Fibonacci level and aligns with other indicators like the RSI or Bollinger Bands, it can create a strong setup for a trade. Now, finally, we are going to be looking at volume indicators. Okay, now volume is one of the most important factors in day trading. High volume confirms strong trends, while low volume can indicate potential reversal. So one of the best volume indicators to use is the VWAP. Okay, the volume weighted average price. That's actually one of the best volume indicators to use. But another because the VWAP helps identify market trends and key price levels throughout the trading session. But another useful and popular indicator, volume indicator, is the unbalanced volume. The unbalanced volume. The OBV measures buying and selling pressure to confirm trends. If price is rising while OBV is increasing, the trend is likely to continue. If price is rising but the OBV is declining, it could signal a reversal is near. So each of these indicators work well on its own, okay, but the real power comes from combining them. For example, if the RSI and the Stochastic Oscillator both show oversold conditions while price is near a Fibonacci support level, this could be a strong buy signal, right? It could be a strong buy signal. And if the Bollinger Bands show a squeeze and price breaks out with high volume, it could indicate a strong trend continuation. The key is to use multiple indicators together to confirm signals and reduce false entries. Using leading indicators can help day traders stay ahead of the market and make more informed decisions. Remember, no single indicator works 100% of the time, so always use them in combination for better accuracy. What is your favorite leading indicator for day trading? Drop a comment below. I'd love to hear your thoughts. And if you found this video helpful, make sure to smash that like button, subscribe to the channel, and turn on notifications so you never miss an update. More powerful trading strategies are coming soon. Thank you for watching, and I'll see you in the next video.